For a long time, money felt almost free. Loans were easy. Interest rates were low. Markets kept rising. And everywhere you looked, people were making money. Buying homes they couldn't afford. Investing in assets they barely understood. Starting businesses with borrowed capital. It felt like opportunity. It felt like growth. It felt like the system was finally working for everyone. But here's the uncomfortable truth. Cheap money doesn't remove costs. It just delays them and moves them somewhere else. And eventually, someone pays. Usually everyone. Right now, we're living through the consequences of that illusion. Rising prices. Expensive housing. Higher interest rates. Slowing growth. Things feel tighter. Harder. Less predictable. And it's tempting to think this is the problem. But what if this isn't the problem? What if this is the bill? To understand why cheap money becomes expensive, you have to start with what cheap actually means. When people say money is cheap, they're really talking about one thing. The cost of borrowing. Interest rates. When rates are low, borrowing becomes easy. Businesses can take loans at minimal cost. Governments can spend without immediate pressure. Consumers can finance homes, cars, lifestyles. And when borrowing becomes easy, spending increases. That sounds good. It usually is, at first. Think of the economy like a machine that runs on credit. Credit fuels activity. More credit means more transactions. More transactions mean more growth. So when central banks lower interest rates, they're essentially pressing a button that says, let's make it easier for everyone to borrow and spend. And for a while, it works beautifully. Growth accelerates. Markets rise. Confidence builds. But beneath that surface, something else is happening. Something slower. Quieter. But far more important, because when money is cheap, it doesn't just increase good decisions. It increases all decisions. Good ones. Bad ones. And everything in between. Imagine you're running a business. If borrowing is expensive, you're careful. You invest only in projects that are likely to succeed. You think twice before taking risks. But if borrowing is cheap, the math changes. Suddenly, even mediocre ideas start to look profitable. Projects that wouldn't make sense at 8% interest start to work at 2%. So you invest more. Not necessarily better. Just more. Now multiply that behavior across the entire economy. Thousands of companies. Millions of consumers. Governments with almost unlimited borrowing capacity. All responding to the same signal. Money is cheap. Borrow more. This is where the system begins to distort. Because cheap money doesn't just increase activity, it lowers the quality of decisions. Capital starts flowing into places it normally wouldn't. Unprofitable businesses get funded. Speculative assets get inflated. Debt levels rise quietly in the background. Everything looks fine. Because everything is growing. But growth, in this case, is being powered by something fragile. Cheap debt. There's a strange irony here. The easier it becomes to borrow, the less disciplined the system becomes. And the less disciplined the system becomes, the more fragile it gets. Now let's zoom out. Because cheap money doesn't just affect businesses. It reshapes entire markets. Take housing. When interest rates are low, mortgages become cheaper. That means more people can afford to buy homes. Demand increases. Prices rise. At first, this feels like a positive cycle. Homeowners build wealth. Construction increases. The economy benefits. But here's the catch. The price of housing isn't just rising because homes are more valuable. It's rising because money is cheaper. In other words, people aren't buying more expensive homes. They're borrowing more money to buy the same homes, and that difference matters. Because when the cost of money changes, the entire equation changes with it. The same pattern repeats across markets. Stocks rise because future profits are discounted at lower rates. Tech companies grow rapidly because capital is abundant. Governments expand spending because debt feels manageable. Everything becomes bigger. But not necessarily better. Now comes the part most people don't think about. The hidden cost. Cheap money doesn't exist in isolation. It has side effects. And one of the biggest is inflation. When more money is created and circulated, without a matching increase in real productivity, prices begin to rise. Slowly at first. Then more noticeably, food becomes more expensive. Rent increases. Everyday costs creep up. And here's the irony. The same cheap money that made borrowing easier is now making living more expensive. So while assets are rising, so are expenses. And for many people, wages don't keep up. This creates a quiet divide. Those who own assets benefit. Those who rely on income feel the pressure. This is where cheap money starts to reveal its true cost. Not immediately, but over time. Now let's talk about what happens next. Because cheap money doesn't last forever. It can't. Eventually, inflation becomes too visible to ignore. Central banks step in. And they do the opposite of what they did before. They raise interest rates. This is where everything changes. Suddenly, borrowing becomes expensive. Loans cost more. Debt becomes heavier. Spending slows down. But here's the problem. The entire system has already adjusted to cheap money. Businesses expanded based on low rates. Consumers took on debt expecting affordability. Governments increased spending assuming low costs. Now, the rules have changed. But the commitments haven't. This creates pressure. A lot of it. Companies that relied on cheap debt now struggle to refinance. Homeowners face higher mortgage payments. Governments deal with rising interest costs. And what once felt like easy growth starts to feel like a burden. This is the moment when cheap money becomes expensive. Not because the money itself changed, but because the system built around it did. Think of it like this. Cheap money encourages expansion. Expensive money forces contraction. But contraction doesn't happen smoothly. It happens through stress. Through corrections. Through pain. Markets fall. Projects fail. Debt gets restructured or defaults. And suddenly, the cost that was delayed becomes unavoidable. There's another layer to this. One that makes the system even more complex. Time. Cheap money pulls demand forward. It encourages people and businesses to spend now instead of later. Buy the house today. Invest today. Expand today. But when future demand is pulled into the present, what's left for the future? Less demand. Less growth. More dependence on continued cheap money. This creates a cycle. To maintain growth, the system needs ongoing stimulus. Low rates. More liquidity. More borrowing. But each cycle adds more debt. And each cycle makes the system more sensitive to changes. Eventually, even small increases in rates have large effects. Because the system is now built on a foundation of cheap money. This is why tightening cycles feel so painful. They're not just adjustments. They're reality catching up. Now let's address something that often gets misunderstood. Cheap money is not a mistake. It's a tool. During crises, lowering rates can stabilize the economy. It can prevent collapse. Support businesses. Maintain confidence. The problem isn't the tool. It's how long it's used, and what builds up during that time. Because every period of cheap money leaves behind a footprint. Higher debt. Higher asset prices. Greater inequality between those who own assets and those who don't. And when the cycle turns, those imbalances don't disappear. They get exposed. There's a subtle but important shift that happens here. During the expansion phase, cheap money feels like opportunity. During the contraction phase, it feels like risk. Same system. Different perception. And perception matters. Because markets are driven not just by fundamentals, but by expectations. When people believe money will stay cheap, they take risks. When they believe it won't, they pull back. That shift in belief can move trillions of dollars. Now zoom out even further. Because this isn't just about individuals or markets. It's about the structure of the entire global economy. Countries depend on borrowing. Corporations depend on financing. Consumers depend on credit. Cheap money connects all of these layers. It makes the system function smoothly. But it also makes it dependent. The longer the system operates on cheap money, the harder it becomes to function without it. And that creates a dilemma. If rates stay low, inflation rises and imbalances grow. If rates rise, the system slows and stress appears. There's no perfect outcome. Only trade-offs. And those trade-offs affect everyone. Even people who never take loans. Because prices, wages, opportunities, all adjust based on the cost of money. This is why cheap money eventually becomes expensive for everyone. Not just borrowers. Not just investors. Everyone. Because the system doesn't isolate the effects. It distributes them. Quietly at first. Then all at once. So the next time you hear that money is cheap, or that borrowing is easy, or that the economy is being stimulated, pause for a moment. And ask a different question. Not, how can I benefit from this? But, what is this going to cost later? Because the real story of cheap money isn't about the boom. It's about what comes after. And maybe the most important question isn't whether cheap money is good or bad, but whether a system that depends on it can ever truly be stable. Or if it's always just moving the cost further into the future, until the future finally arrives.